There are a couple of important differences we think relative to indexes compared to an ETF or a mutual fund. So one is it's a pooled fund that you're investing in if it's an ETF or a mutual fund. You have no ability to change what's in that fund. You get what it is, and you are beholden to whatever Vanguard's doing, whatever the manager of that fund is doing. And so it's a great strategy, but it does have limits in terms of you can't customize it if you wanted to not, invest in a certain security, that the index is.
I'm your host, Melanie Schaefer. Welcome to Lead Lag Live. Now, these days, everyone's looking for smarter ways to invest, not just to chase performance, but to actually manage it. With this in mind, Public, a multi-asset investing platform, just rolled out fully customizable direct indexing, a feature that lets investors build their own index, own the individual stocks inside it, and even optimize for taxes automatically. And here's what's different. You don't need to be a millionaire to do it. For the first time, Public's bringing direct indexing to everyday investors with just a $1,000 minimum and an annual fee that's under 20 basis points. That's a massive shift from what's traditionally been a high net worth strategy. My guest today is Sam Nofsinger, the General Manager of Brokerage at Public. Sam's been leading this rollout, and it's great to have him here. Thank you so much for being here, Sam.
Thanks so much, Melanie. Pleasure to be here. And we're really excited for this launch.
So just to get started, can you tell us a little bit about what the big picture is? Why did you launch direct indexing now? And what problem were you trying to solve?
Sure. Index investing, I think, has been around for a long time. And I think most investors know that tracking an index, following an index, investing in index funds is generally a relatively good way to build long-term wealth. Historically, the only way to access investments in an index, which are basically baskets of stocks that are tracking some type of methodology, whether it's the S&P 500 or the Nasdaq, the only way to access investments in these indexes was to buy a mutual fund or an ETF that track these indexes. So you would buy the Vanguard S&P 500 ETF. That would be one ETF that would track the S&P 500. And that was how most investors, individual investors, would get access to a lot of these index products. So ETFs and mutual funds are a great way to access these indexes, but that we think there's an even better way, which is direct indexing. Direct indexing as an investment strategy has been generally, as you mentioned, available to ultra high net worth investors. And so what is it? Instead of buying an ETF or a mutual fund that tracks the index, you actually go out and buy all of the underlying constituents of these index. So if you're tracking the S&P 500, you'd go out and buy all 500 securities, within that index, and then you would track it that way instead of owning, a fund or, an ETF. And the ability to own the underlying holdings directly as opposed to a fund comes with a lot of benefits. For one, our investors are allowed to customize the direct index. So if you don't want energy in the S&P 500, or you don't want, NVIDIA or Tesla, for instance, you could exclude those from your personal index. And now your index, right, is not tracking the index, but tracking a more personalized, customized version that is suitable to you and your investment strategy. And so, you're able to customize it, you're able to personalize it. There are also extra tax benefits. So we have a tax loss harvesting methodology that we employ. So every day, we're searching for losses, trying to generate, losses to offset gains in your other portfolio so that your compounded returns are even greater than they otherwise would have been. And so for us, we think direct indexing, where you're able to invest in the underlying securities, is a really, really good way for investors to build long-term wealth and achieve their financial goals, over the coming years.
Yeah. So I just want to take a step backward to the side, actually, just for a minute, and let you speak to people who are hearing about direct indexing for the very first time. How can you describe it very plainly, in plain English and in the most simplest way possible?
So direct indexing is an investment strategy where an investor chooses an index, and instead of buying a fund or an ETF that tracks that index, you actually purchase the underlying holdings of the index instead.
So what's really the difference then between owning an ETF and owning the actual stocks inside the index itself? I know you've touched on that a little bit, but I want to get more into it.
There are a couple of important differences we think relative to indexes compared to an ETF or a mutual fund. So one is it's a pooled fund that you're investing in if it's an ETF or a mutual fund. So you have no ability to change what's in that fund. You get what it is and you are beholden to whatever Vanguard's doing, whatever the manager of that fund is doing. And so it's a great strategy, but it does have limits in terms of you can't customize it if you wanted to not invest in a certain security that the index is. I think another is, you don't have the ability to, tax loss harvest an ETF, and tax loss harvesting is a very important strategy, in direct indexing relative to an ETF. So if you think about owning an ETF, if the stock market is up in a year, that stock market has gains, and there's no ability to tax loss harvest. If you own the 500 individual stocks, however, that replicate that index, in any given year, there's a good chance that a lot of those stocks will be down, even if, right, in aggregate, they are up. And so by owning the individual holdings, you're able to sell, the stocks at a loss and reinvest them in similar securities. And you're still able to get the exact same performance as the ETF or the mutual fund, but you have an extra tax benefit that you would not have had in the ETF. So I think it's personalization, customization, the ability to tax loss harvest the underlying holdings are very, very big benefits, for an ETF, for a direct index over an ETF.
Yes, Sam, for advisors watching, how should they think about using direct indexing for their clients? And when does it make sense for them to use it alongside maybe ETFs?
I think for financial advisors, it's a really, really good toolkit, tool that they can have in their toolkit. For one, I think they can go out to their, customers and say, instead of investing in this broad index that everyone can invest in, let's devise a strategy that is, bespoke to your situation. So what are your values? Where do you think, growth lies in the economy? Let's build an index that actually replicates, where you want to invest as opposed to kind of, where the industry, wants you to invest. And so for advisors, it really allows, that one-on-one relationship, to blossom as they're able to basically dig into this, this investors, actual personal values and create, a vehicle that will perform similarly to the broader market, but is bespoke to them and really captures their values and where they think they should be invested. There are also, I think, cost benefits. So a lot of direct index, products are very, very cheap. Ours is, 19 basis points. The average ETF, I think, is 75 basis points. So it can also be a good cost savings, for advisors as opposed to investing in ETFs. And so I think for advisors, looking whether they want an ETF or whether they want direct indexing, direct indexing gives them a lot more customization. And it also, allows them to have much, much deeper conversations and understand their clients and build those personal relationships that are very, very important in the advisor-customer relationship. And that's not said that ETFs, don't deserve a place in the portfolio. ETFs, can have a very, very important role. For instance, it's harder to direct index in an international stocks. So you may want an ETF for your international exposure because it's more difficult for, domestic investors to, access the underlying stocks of a Chinese index or a European index. So international may be a very, very good place to still have, ETF exposure, while, if you're investing in the US, direct indexing may be more appropriate there.
Yeah, and you've mentioned it a couple times, but one of the biggest draws is tax loss harvesting. The idea of turning derivatives into potential tax advantage can you explain how it actually works behind the scenes at public? And what do investors need to understand about when and how it kicks in?
Sure. So tax loss harvesting at a high level is the process of looking through all of the holdings in a portfolio, looking for holdings that are at a loss, an unrealized loss, selling those securities to actually turn that unrealized loss into a realized loss, and then using the cash proceeds to buy a stock that is similar in nature and is expected to perform similarly so that your overall portfolio still is on, tracking the index. And so if you're still tracking the index, but you've harvested this realized loss, and that's a really, really good tax benefit that in the future you can use to reduce your tax payments. And so instead of paying $10 to the government next year, you can put $10 back in your investment portfolio, and that compounds year after year after year after year. And so it's not just the first year of savings that you get from tax loss harvesting, it's that these savings in this first year and the second year and the third year compound for the rest of your life. And so the tax compounding benefits of tax loss harvesting is really a huge benefit of direct indexing versus an ETF.
Yeah. And as I mentioned in my intro, you dropped the minimum to just $1,000, big change from traditional direct indexing, which used to start even in the six figures. Why was it important to lower that barrier?
So I've been in this industry for 20 years, and direct indexing has been the next thing for literally the past 25 years. And I think finally this year, it's going to ring true. And a lot of that has become, advancements in technology. 25 years ago, there was not fractionalizing of securities. So if you wanted to buy, the S&P 500, you had to buy one share of each of those things. At the time, Amazon was $1,800. So if you wanted to buy the whole index for $1,000 and one stock costs $1,800, you can see how that doesn't add up very, very quickly. So one of the things that the industry had to do was fractionalize securities so that you could buy any stock for as little as $1 or $5. And so that opened up that reduced the minimums a lot because it became a lot easier to access every single, investment in these indexes, because instead of having to have the dollars for the price of the stock, you just had to have, the ability to invest $1 or $5 in the underlying. And so that was a huge benefit, was just bringing the dollar size of each stock down. Another thing was lowering costs through automation and technology. So historically, there would be a portfolio manager who would be looking at these portfolios, placing the trades, making sure they were in line with targets. All of that is now done behind the scenes, through our software, through our automatic, rebalancing tools that look for all the nuances, look across all the portfolios, run a whole bunch of math behind the scenes to recommend their actual trades that we place every day in order to keep you in line with your index, but also generate losses so that you have tax benefits that you can use, in the future. And then I think the third point why it's actually, the time for direct indexing is because, the average individual investor is very, very smart and sophisticated these days. Every day we are seeing our investors get more smart, more sophisticated, and more intelligent about what products they want and where their investments, where they want their investments to be. And so we've had a lot more people asking about, direct indexing over the past couple of years, because I think the individual investor now understands, the benefits not just of, investing in index funds, but actually owning the underlying securities and the added benefits of, investing in index directly as opposed to the ETFs. So I think, a lot of it is technology, bringing down, the size of a share from, hundreds of dollars, thousands of dollars to $1, $5. It's, behind the scenes technology so that all this automatic, portfolio management can be scaled across thousands and millions of accounts. And then I think a lot of it is, us and our peers have done a great job educating investors over the past 5-10 years about the benefits of long-term investing, the benefits of, index products, and the benefits of owning stocks directly and being able to customize, to your personal needs. And so finally, I think, for anybody out there, $1,000 is pretty, low hurdle for folks to get, an institutional quality asset that they can, have around for the rest of their lives.
Yeah, and to add on to that, since the launch and even more in general, how are you seeing investors using this flexibility? Are you seeing people build around values, sectors, or performance themes, et cetera?
Yes, there are a lot of people who, certainly I think the core of our base continues to just want very, very standard index products. So a lot of people do the 2-click S&P 500. That's good enough for me. But we are seeing, about a quarter of our investors either choosing, more niche investors, whether they're sectors or even subsectors such as semiconductors. But we're also seeing folks exclude, a lot of companies. And a lot of folks, are, it's, the energy companies that may not ascribe to their values. So we're seeing a lot of, folks, exclude certain companies that may not align with their values. We're also seeing, folks exclude holdings that they have a lot of exposure to already. A lot of our investors are, have a very large holdings in Tesla and Nvidia and Microsoft and Apple. And so a lot of our investors are actually designing indexes that diversify their current holdings away from some of these concentrated positions. And so, for instance, we have a couple folks, we have a lot of folks, who work at large tech companies, and a lot of their compensation, for instance, is in their company's stock. And so if they wanted to, they can go to direct index, basically exclude their company's stock. And then as the losses generate in their direct indexing, they can take gains in their concentrated position. And so we've seen a lot of different use cases for it. People are either targeting specific, sectors or areas that they think are poised to grow, or, they're building diversification around their main holdings in their main brokerage accounts. And so we're seeing a lot of different use cases for direct indexing. And they're all, great as far as we can tell.
And finally, for anyone who wants to learn more about Public's new direct indexing platform or try it out, where's the best place to start?
Public.com is the place for everything about where you can find information on our firm, on all the different products, on direct indexing. You can see all of the different indexes that we have to choose from. There's over hundreds of them. And then you can sign up for an account and you'll see how it works for yourself.
Sam, thanks so much for joining me. And thanks to everyone for watching. Be sure to like, share, and subscribe for more episodes of Lead Leg Live.
Thanks so much for having me, Melanie.